Several times a week, we get people contacting us that have bought a policy and want to know if they're paying too much for it. So I wanted to take a moment and run through a scenario of how you can tell whether or not the real cost of insurance that you're paying is worth it. In this example, we had an IUL policy, or an indexed universal policy, presented to us where someone was paying $3,192 a year for premium. And so to see whether or not this was too expensive, we matched the IUL coverage, which was $300,000, with a simple convertible term policy that gave 30 years of coverage. And we used 30 years of coverage because, as you'll see later on in the presentation, the guaranteed cash value in 30 years on the IUL policy was zero. And so to match that apples to apples, we took a term policy that will have a zero cash value in 30 years, but the same amount of coverage. As you can see right here, the coverage, if that's all we're solving for, is much cheaper with a term insurance policy. And if we took the difference between what the IUL policy was paying, $31.92, minus the $701 for the term, we would have $2,491 left to buy a whole life policy that would have a fixed premium for life and a guaranteed cash value that wouldn't disappear in 30 years. And we'll see what that looks like down the road. So over the course of 30 years, the term policy ends up paying $21,030, and they've had $300,000 of coverage. The IUL policy ends up paying $95,760, and they've had $300,000 of coverage. And the whole life is just the leftover money if you bought the term instead of the IUL, and you still have got coverage of somewhere around $167,000. So the coverage isn't as much in the whole life, but paying the same amount of money for whole life and term, you would have had $300,000 of coverage in the term, $167,000 in the whole life, which is a whole lot more than what you would have guaranteed cash value or death benefit in the IUL policy. In fact is, after year one, there's zero cash value or surrender value in the IUL policy. The term policy, of course, never builds any cash value, but you have $1,055 of surrender value in the whole life policy. By year 5, there's still zero surrender value in this IUL policy, and in the term policy, there was never any cash value or surrender value. But in the whole life, you already have $10,174. So if you were forced to not be able to pay this premium in any of these policies, the whole life policy would give you a higher return on what you had paid if you had to cash out of the policy. After 30 years, as we said earlier, the guaranteed cash value in the IUL policy has zeroed out. And the reason that is because in the IUL policy, the cost of insurance continues to increase, just like in the term policy. And so now we see the mirroring of the term and the IUL policy, because really all the death benefit is in an IUL policy is a separate piece of term insurance that's being paid out of the accumulated cash values or from the premiums that are being paid out of your pocket. Now, if we don't increase the premium that you're paying on that IUL policy over the years, then the guaranteed cash value will disappear sometime before you die. Whereas in the whole life policy, you can see the cash value is now $72,383. Obviously, if you're solving for guaranteed cash value, there's only one choice. Let's look at the real cost of this. You could have had the same life coverage, death benefit, if you bought term and only paid $21,030 as if you paid $95,760 for an IUL policy. The exact same coverage, but look at the price difference. Now, if we're just taking the difference between $21,030 and $95,760, then we come up with $74,730 that we could have paid to a whole life policy. And the cash value in that is $72,383. That's guaranteed. That means that if you had to surrender that policy in 30 years, the whole life policy only cost you $2,347. That's a big difference from $95,760 and a significant difference from $21,030. And again, that's just leftover money. You could have bought the term and the whole life and spent the same $95,760 as you did on the IUL policy. So those are guaranteed numbers. So let's break it down. You can pay $21,030 for $300,000 of coverage for 30 years, or you can pay $95,760 for $300,000 of coverage. You'll still have nothing to show for it, guaranteed, whichever one you buy. Or you can pay $2,347 and have $91,602 of coverage. Now, how did I come up with $91,602? Well, I took the $166,332 that was guaranteed death benefit in the whole life policy and took away the $74,730 that we spent for the product, and we came up with $91,603. And of course, the slide previous to this showed where the $23,447 came from. So let's look at total cash values, because that's what most IUL agents are focusing on. They're enticing people to look at what this product could perform like. And now we're talking about speculation, because there's no guarantee of what the index that the IUL is mirroring will ever perform like it's shown on the illustration. In fact, as if you read your illustration or your contract with an IUL, it will always say that those aren't guaranteed numbers. It could be much worse or it could be better. Well, here's what it looks like in this policy that we were asked to review. Again, in the green box, the IUL, they were going to pay $95,760 of premiums paid. The guaranteed cash value in 30 years was $69,996. They still have not broken even with the return that this company is projecting they will be able to mirror and credit this policy with over 30 years. They were following the S&P 500, and they were projecting a 7% return rate. And so the IUL policy has still cost $25,764. The term policy is cheaper. Without any expectation at all, it only cost you $21,030. Whereas the whole life policy, which we're just using leftover money from buying term out of what we were paying for IUL, we've got a positive number there of $4,720. Now, what would happen here is if we took all the money, instead of buying term and whole life, what if we took all the money that someone was paying for an indexed universal policy and put the $95,760 into whole life? Well, now we can see a huge, significant difference. We've got $65,763 of real positive gain there instead of a $25,764 loss. It really, when you break it down, you can see that the indexed universal policy is costing a lot more than either term and whole life combined, or just whole life by itself. The real cost of insurance must take into consideration all associated fees. Now, in an IUL policy, we're looking at premium fees, We're looking at monthly fees. We're looking at trading fees, rider fees, and administrative fees. On this small, all IUL policy, the fees added up to $626.88, which was 20% of the annual premium. Those fees could go up because the premium fee is based on how much premium you're paying. It could go up on how often the fees are charged for riders or administrative costs, or even and usually the monthly fees in an IUL policy are fixed. Okay, but when someone is charging a percentage of what you're paying, now if you pay more premium, which an IUL policy usually has a flexible premium, so you can pay a little bit more one year, a little bit less the next year. Okay, every time you pay more, you're paying a higher percentage. On the term and the whole life policies, the fees are fixed. And this is really critical when you're looking at the real cost of insurance. The real cost of insurance is fixed in a whole life and term policy, $75 annually. That beats $626 all to pieces. And really, this amounts to 10% of what the term policy is costing, and about 3% of what the whole life policy is costing. But more importantly than that, that fixed $75 is already considered in your annual premium. So if you're paying a flat fee for your insurance, whether it's term or whole life, there's not going to be any more fees added to that. That $75 comes out of the premium that you paid. The premium fees, monthly fees, trading fees, rider fees, and administrative fees on an IUL policy come after you have paid your premium. And so they are additional cost above and beyond your premium payment. Huge difference between whole life and universal life products. For these reasons and others, Life Benefits never recommends universal life products. Never. As this presentation demonstrates, universal life products over the long term are more expensive than owning term and whole life, or just whole life alone. But even more importantly, purchasing a term insurance policy and a whole life insurance policy combined provides you with more options than purchasing a universal policy both today and later on in the future. And that's what we're all about. Options always carry with them the ability to keep more and make more of the money. And these facts are important for you to understand so that you can make the best choice today, so that you don't take opportunities off the table now that you could exercise and make or keep more money in the future. So have a great day and realize there is a cost to insurance, whether it's term, whole life, universal life, indexed universal life, variable universal life. And we have to look at the data to realize really what is the cost of insurance. Because the cost of insurance can be crippling on some of these products, and that's why we made this presentation for you to understand.